Howdy, welcome back to another Dion Talk. In today's video, I'm going to talk about the 4 ways that rental properties pay you. And at the end of today's video, I'm going to talk about what my brother said to me that stopped me from investing in rental properties for over a decade. When first starting out, almost every investor that I know, and myself included, focuses on the first way that rental properties pay you, and that is cash flow. Cash flow is money that you receive every month that you can spend, save, or invest. And there's a couple different ways to look at cash flow. A lot of times people say, what's the cash flow? And they figure my rent that comes in every month, and I'm going to use really round numbers here that probably aren't accurate to anybody's story, but it's easier to do the math. If I have $1,000 a month coming in for rent and my mortgage going out every month is $500, that means I have $500 in cash flow. And technically that's probably the correct use of the word. But that's not how much money you're making. Your mortgage, if it includes principal, interest, taxes, and insurance, is just the first step. Even if you buy a place all cash and don't have a mortgage, you're still going to have insurance and taxes. But then we need to be setting aside money for things that are going to come up in the future, like capital expenditures. Eventually the place is going to need a new roof. Your foundation might need some work. A hot water heater can go out. You're going to need to pay for simple repairs and maintenance. Paint eventually fails. Lawn care, trash, depending on the type of rental that you have. And then you need to be saving for vacancy. Eventually you're going to have a tenant turnover. And if you haven't set aside the money to clean or replace the flooring, to paint the walls, to fix the little bit of damage that there was, most times a person's deposit can cover some of that, but not all of it. So if you're not setting aside for those, if your cash flow is $500 a month, like the example of taking in $1,000 and paying a mortgage of $500, and a tenant lives there for a year and they move out and it costs you $5,000 to fix everything, that's pretty much most of your cash flow from that year is gone. So you really weren't making any money. So whenever I'm purchasing a place, I like to shoot for a 10% or better cash on cash return. It's not how much money I'm making, it's how much money I'm profiting after principal, interest, taxes, insurance, setting aside for repairs and capex and vacancy. The money that's left is what is called pure cash flow. A lot of times cash flow is just the gap between rent and mortgage, but pure cash flow means what you're actually profiting. The second way that rental properties pay you is through appreciation. Usually, over time, the value of property generally goes up. If you notice, I said usually and generally. This is not a guarantee. And when things like the 2008 recession happen, the housing crash, property values can drop significantly. So there are some people who have invested in specific markets hoping to gain appreciation faster than in other markets. And sometimes doing this without even counting on cash flow. But it's really hard to predict the future. And what we're seeing right now from 2020, the pandemic, is, there's almost 400 housing markets in the United States. And while prices continue to go up, as a general rule across the board, there are a lot of major cities that are actually seeing prices soften or go down. With working from home being an option and social distancing to avoid a virus, it is starting to look a lot more attractive to people to move out of the city and pay $1,500 a month for a mortgage than it is to live in the city and pay $4,000 a month for an apartment. But there is another aspect of appreciation that I really like when it comes to rental properties, and that is leverage. I'm not saying go out and take out a bunch of loans and get leveraged to where you're over leveraged and you can't handle a problem when they come up. But to look at the really simple math, if you were to buy a $100,000 house and you had $100,000 and you paid cash, and then you look at another place that's worth $400,000 and you put $100,000 down, 25% on an investment property, and then they were both to appreciate 10%. In the first scenario, you spent $100,000, you own a $100,000 asset, and it goes up $10,000, you have gained $10,000 in appreciation. In the second scenario, you put down $100,000 to purchase a $400,000 asset. If it goes up 10%, that's $40,000. Spending the same amount of money, you've gained 4 times the amount of appreciation. The problem with leverage is that properties can also go down in value, and so you amplify that effect when you have a mortgage. My original strategy with mortgages to avoid becoming over-leveraged was to pick 4 mortgages. Some lenders, larger ones like Wells Fargo, Bank of America, now they might take you up to 10 mortgages, but generally they limit a person to 4. And other lenders like Fairway Mortgage, Guild Mortgage, they'll take you up to 10. Local credit unions will do that. But I figured the banks that chose 4 thought it was the safest number, the least amount of foreclosures, the smallest amount of loan defaults. So I picked 4 as well. I had 4 mortgages, and then I paid one off, and then I saved up a down payment to buy another one. So this way I was benefiting from leverage, but I'm not over leveraged. And then my strategy shifted in the last couple of years because interest rates started dropping. When I was paying 5.5%, it made sense to me at least, to pay the mortgage off. But now that I'm getting rates of 3%, it doesn't make as much sense to pay off a mortgage because I'm getting such a better return when I buy a property. I'm getting better than a 10% cash on cash return so far on every property I've purchased. And that's in the first year. That cash on cash return increases over time because generally mortgages stay the same and rents go up. The third way that rental properties pay you actually only pays you if you have a mortgage. If you don't have a mortgage, you're still making this money, it's just coming directly to you. But with a mortgage, every month, the tenants will pay off a portion of your loan. So if you have a mortgage, you're going to benefit from what is called principal pay down. In the beginning, it starts off as a small number because of the way that a loan is amortized over 30 years. In the beginning, you're paying very little on the principal and a lot of interest. And then over time, those two numbers shift. So you pay less and less interest and more of the principal until a little after the middle point, they switch sides. And towards the end of your mortgage, you're actually paying more into the principal every single month. With my units, right now I have 14. Every single month, the tenants are paying down $2,500 of the principal balance. That actually goes up somewhere around $8 to $12 a month. So every month, even though right now it's around $2,500, and next month it'll be $2,510. Cash flow is the thing we focus on in the beginning, usually, because we're trying to replace our cost of living expenses. But over time, what we realize is appreciation on 4 times what we spent and principal pay down is what actually makes us the most money over time. I was watching the BiggerPockets episode with Meet Kevin, and in the episode, it seemed like Kevin had a dawning realization. There's actually a point where he kind of like stops, reaches around and grabs a notepad and takes a note. Everybody was focusing on cash flow, and he was pointing out that appreciation and principal pay down are what makes you rich, and the cash flow protects your asset when things go bad. Yes, there are years when property prices might go down, and if you had to sell in 2008, 2009, 2010, you probably lost a lot of money. A lot of people did. But if you are a buy and hold investor like I am, my intention is really to never sell. I don't care when there are dips in the prices. Actually, the years when property values might go down, that would be the time that I go and argue with the county tax assessor to get my property taxes to go down too. Which brings me to the 4th way that rental properties pay you. It's not so much getting paid, but it's that it is an expense that you can delay possibly forever. And that is the tax benefits that come with owning rental properties. It's a business. Even if you are a sole proprietor and you own everything in your name, or in an LLC, there's really no difference. Most of the LLCs that have rental properties in them are just pass-through entities. So someday I might make a video as to whether somebody should have a property in their own name or if they should structure LLCs to put the properties in. And that is a really heated topic that comes up in the forums and BiggerPockets often, and people are really polarized on that. So I may make a video about that, but not today. The tax benefits when it comes to rental properties are really attractive to investors. The government encourages people to become investors, especially in real estate. Since it's a business, the taxes are structured a lot different than the income you get from a job, like a W-2 income, where your company writes a paycheck, the government takes their taxes out, and then you get what's left. With rental properties, you get to collect all of the rent, and then you get to deduct things like parts of the mortgage, interest, taxes. You get to deduct write-offs. Whenever you repair something on a rental property, that expense comes out before the income is taxed. And then even the money that's left, you might be able to reduce the amount of tax you owe on that as well, with the best benefit that there is with rental properties, and that is depreciation. Over time, even though your property can appreciate and be worth more value, every year you get to tell the government that the structure is a year older. You get to take that amount of money as a loss against the rental profit that you made that year. Let's quickly recap all 4 of the ways that rental properties pay you. The first is with cash flow. The second is with appreciation. The third is with principal paydown. And the 4th is with the tax benefits. These are the 4 most common. And I didn't even bring up house hacking, which was a big part of my strategy. I've house hacked twice. And reducing or eliminating your housing costs has the biggest impact on my savings rate that I could think of. While cash flow has made work completely optional, I get to do a job that I love. I don't have to worry about how much money I'm making. If we go back about 10 years, I was a single parent with 3 kids, $89,000 in bad debt. I just started working at a truck driving school, teaching people how to drive trucks for $17 an hour. That's what I was making. And you go forward till now, my cash flow rental profit from 14 units is over twice what I was making when I was a police officer. And my kids are going to inherit a couple of $1 million in rental properties. Being a landlord might not be for everybody. There are several ways to invest. Rental properties is just one, and you can make it as passive as you want. You can have rental properties that you self-manage. You can have a property manager. You can get into self-storage where there are no tenants to take care of. You can invest in the stock market. There are a lot of strategies that people have used with investing in stocks to reach financial independence. You can start and grow a business and then have other people run it. And the real concepts are almost always the same. Make as much money as you can, spend less than you make, and invest the difference until that investment makes work optional. At the beginning of today's video, I talked about explaining why I waited over 10 years to get into real estate because of something that my brother said. My brother, who is completely retired off of his rental properties, he has 10 that are paid off, makes 6 figures, travels the world doing whatever he wants to do. Real motivating person in my life that I look up to. But when he first started getting into his rentals, he was explaining it to me one day, and he said, I purchased this property and I fix it up and I rent it out. Based on the profit from the property, I will have my money back from that investment in about 11 years. And my brain broke. So he had money and he spent it so that in 11 years he would get it back. That seemed like a lot of extra steps that he could have just kept the money when he started. Until one day it dawned on me that he wasn't spending the money. I'm not spending money when I buy a property. If I buy a $400,000 property and I put $100,000 down, or he buys a mobile home on acreage in the middle of nowhere and he puts $100,000 on it, the money's still there. It's still ours. It's just not sitting in a bank. It's sitting in that property. Eventually we can sell, or we can do a cash out refinance, or he took out home equity lines of credit on his paid off property. That money is still there. It is still ours. It's just not sitting in a bank paying us a microscopic amount of interest. It's sitting in the property, giving us cash flow now to spend, save, or invest. It's gaining us appreciation. I'm getting principal pay down. We get the tax benefits from it. I delayed getting into rental properties for almost 10 years because of the way I was thinking about how the money worked. And it is amazing what a little bit of education can do for you. People here, people on YouTube, watching videos, you are already 100 times ahead of almost everyone else out there. Even with people in my life that I had that were examples of reaching financial independence through rental properties, I had the wrong perception for almost 10 years. So good job doing the research, good job educating yourselves. Get out there, start that business, buy those stocks, buy a rental property. One last quick tip before I wrap up for today. A lot of people talk about the debt snowball of paying off your smallest amount that you owe to somebody with some extra money, and when that's paid off, take that payment, move it to the next one with the extra money so that it grows and you snowball into paying off your debt. Not very many people talk about the income snowball. Every time that you buy a cash flowing asset, the amount of money that you can either save, pay down other debts with, or invest grows. You are going to be alive in 5 years. You should start investing like it. I hope I made it worth your time clicking on this video today. If you took anything out of this, please hit like, hit subscribe if you haven't already. Share this with a friend. Hopefully they can learn from it. And until the next video, thanks for coming to my Dion Talk.
We're sorry, the number you have
No,
dialed
actually,
is
it's
not
kind
in
of funny
service
when you
at this
start
time.
recording a video and you put it online, all of your friends call you and they say, hey, did you know your shirt is wrinkly? And they ask you when you went bald. And complete, utter strangers call or reach out and say, this is great content. This is amazing. Please make more. I can't wait for more.